Let's continue on to our market recap. Really on Friday, we wrap the week, which is we try to look big picture, take a step back from all the flickering ticks, all the noise as much as we can. Having said that, I want to start with a poll question. We always have a poll running on our StockCharts TV page and on our YouTube channel, on Twitter. So I'd encourage you to look us up in each of those places and see what you think. Our recent question, the 4 worst performing sectors in Q4 of 2020. So October, November, December of last year were real estate, consumer staples, utilities, and healthcare. Which of these do you think performs best in Q1 in the first quarter? And over half of you, 56%, responded healthcare, which is interesting. It's actually number 2 today. And if you think of the healthcare sector, it's kind of rotated very nicely from a period of, I don't know if I would say underperformance, but certainly was underperforming for much of last year. What I mean is in the fourth quarter, it wasn't a huge loser, but on a relative basis, just didn't get it done. There were just sectors that did so much better. But look at how the relative strength starting to turn higher. You're now getting potentially a higher low on the relative strength. This is healthcare relative to technology at the bottom here, making me perhaps a higher low. A lot of this came from today with a little bounce in the last couple days. I'm also intrigued. Utilities and real estate got a nod. Very few of you said consumer staples. So as a contrarian, I'm always curious what people did not pick. And boy, so far, Final Bar Nation can't disagree with the fact that you'd underweight consumer staples out of that bunch, because certainly not getting it done today, seeing some certain weakness on the downside. The relative strength of consumer staples is what concerns me the most. I mean, in a group of underperforming sectors, you look at where the relative gains have been. In terms of how I would answer that, I would go utilities, healthcare. I get the idea, and I don't disagree. I think you might be onto something for sure. I like the yield in utilities. I like the fact that it's held support, and the relative line, same thing. You're seeing a bit of a higher low here, a potential turn higher. I wouldn't be surprised if both of those sectors do better, especially during a rocky period going forward. But we'll see what we can see. Let's continue on and wrap up this week the best we can. What we like to do is start with our weekly wrap the week chart here. I'm going to update some labels on here. This is a chart which just shows the weekly return in some of the key averages, key asset classes over the last 5 trading days. So starting the clock at last Friday to today, what's happened in these asset classes? The S&P is here down 3.3%. Now, obviously, a lot of weakening going into today and into the close, sort of weaker rather than stronger. So a bit of a downtick, and certainly one of the worst weeks we've seen in quite a while for the S&P. I don't have the numbers, but I would guess this is probably the worst week we've seen since October, would be my guess, during that last sort of pullback period, September, October last year. We had those big down weeks at times. So I wouldn't be surprised that this is the worst one since then. I think that's probably fair to say. The Nasdaq was essentially the market this week, coming off going into Friday or going into the close on Friday. And so both of them down about 3 1/3%. What underperformed stocks? Not much, right? Pretty much most other things, non-equity asset classes did better. Small caps were down about almost 4.5%, 4.4. Emerging markets also down 4.5%. So a lot of weakness. Now, that's China, for example, which gapped up last week, was like the gaps up, the jump higher, the FXI, the MCHI, all making new all-time highs. They all reverted back to the downside. And, it's interesting on a chart like the FXI, we don't have time to get into it. Unfortunately, what you could think about is they've gone so up so quickly and gapped higher. There's a lot of room to come down, just even to reach the 50-day moving average. So, there's a lot of room for the uptrend to still technically be intact, but to give back some more ground. What outperformed U.S. stocks this week? Gold was down about 0.75%. Gold is really in sideways mode, and the chart of gold for me is a jumble of labels and lines, because everything's kind of lining up right about where we're at right now. It's literally the absence of trend, waiting to see which side, buyers or sellers, take control and push gold to its next spot. Crude oil essentially flat for the week. It came off a little bit, 0.1% down. Bonds in the form of the TLT also about a rounding error above zero. The US dollar, the best out of this bunch, up 0.33%. We've talked about this weakening dollar environment for a while and what that means for non-US versus US, small caps versus large caps. Here we see a stronger dollar this week, and we see small caps and emerging markets underperforming, which is sort of what you'd expect in a stronger dollar that's going to favor the larger part of the markets. One thing we do not have on here is Bitcoin. We'll show you this other chart just to show that Bitcoin was certainly the outlier and the winner this week. down, and it was the worst performer as of Wednesday's close. Over the last 24 hours, we've had Elon Musk changing his Twitter profile to just hashtag Bitcoin. That seemed to be enough to push Bitcoin higher. It's amazing. It's a petri dish of speculation and behavioral biases. It's fascinating to observe, and I would encourage you all to reread books like Humphrey Neal's The Art of Contrary Thinking, if I remember right. That's the name of it. Just, it's from decades ago, but so much of it rings true in terms of understanding crowd dynamics and group theory and how they can impact asset prices. So Bitcoin, the best of the group and outperforming pretty much everything else this week. Let's look very quickly at just what happened granular today. So, stocks sort of sold off in the morning after lunch, rallied a bit, but gave back most of those afternoon gains going into the close. So finished back above 3,700. I think it's worth noting that it bounced right off that 3,700 level. Big round numbers tend to have meaning. And so a round number, $100 sort of level usually more often than not proves to be some sort of magnet for prices. And so 3,700 is certainly something to pay attention to. The Nasdaq, as I mentioned, essentially in line, mid caps and small caps down as well. Small caps down only 1.5% relative to 2% for the S&P, and the VIX back above 33. Bond prices today down just a bit with 10-year yields back around 1.1%. Commodities essentially mixed with gold rallying out of the open and sort of a lot of these gaps higher, but gave back most of those gains to finish flat for the day. Silver was one of the only ones finishing more positive. And I mentioned cryptocurrencies overall finishing stronger rather than weaker. In terms of sector leadership, utilities, healthcare, real estate, 1, 2, 3. This is certainly the defensive side of the ledger working today, as I would describe what I've seen this week if I could summarize it. Besides the structural challenges we've had with things like GameStop and American Airlines and other names like that. It's just this general de-risking. It's a rotating to the defensive side of the ledger, taking bets off. So you see energy, technology, consumer discretionary at the lower end of the return profiles today. Let's complete this wrap of the week by looking at the Mindful Investor Live chart list. As a reminder, we'll spend the rest of our wrap the week segment here. If you've not seen this before, this is what we do every Friday. You can access this exact list. Just go to the articles page on your StockCharts dashboard at the top. Click on articles. Go to mine, which is called the Mindful Investor. That's my page, and you'll see a link at the top to this live chart list. You're welcome to save the charts. Do whatever you want with them. We're going to start with the weekly trend model, and I feel like have been a broken record really since October, telling you the long-term, medium-term, short-term trends all positive. That now changes as of today, given the weakness that we have going into the close. The short-term model has turned negative. That's the first time it's been negative since late October. So the previous two times it was negative was here in June, which is during the June market pullback, in October, and in November. So basically coming off the September highs, you have that choppy period of pullbacks before the resumption of the uptrend in November. All three of those, sort of the three most significant pullbacks in 2020, besides the big sell-off in March, all had the short-term model turning negative. It's once again negative. So it definitely tells me on the tactical side, the path of least resistance is down until proven otherwise. I'm really close to this one, and I hesitate to call this a sell signal because it's literally, out to 3 decimal places is right at 0. So I guess I will have to call it a not negative yet. I guess it's sort of like in football, the receiver gets the benefit of the doubt in a reviewed call. So we'll call that still with offense, but boy, it is on warning as being really close to a sell signal in the medium-term model. And for me, when I'm thinking about asset allocation, the medium-term model really is sort of the go-to. The long-term model is really meant to capture these secular moves and tell you when you really need to just get away and look for, and think about the downside potential and prevent maximum loss. But the medium-term model is really more of the money management side of it. So the fact that it's really close to turning negative is certainly going to have my focus going into next week. I think you'll know very quickly as next week starts, on Monday, we'll see whether or not we have further downside. Now, the short-term chart, the daily chart of the S&P, to me, certainly speaks to downside potential. What's interesting is we closed almost to the penny right at the 50-day moving average. What we've talked about is, things that I would be concerned about if I'm short-term bearish. Number one would be the trend lines off the lows and that being broken. That actually happened on Wednesday. And I think given today's lower close, we now have a validated breakdown. We sort of bounced yesterday, which could have been a reversal back above. We did not get that. We've now confirmed the breakdown. And for me, the short-term trend is lower. We've now broken down through the most recent swing low. That's around 37.50. We've now broken that. The 50-day moving average is sort of the last thing. In my opinion, I've seen enough to suggest I'm going to assume the trend is lower going into next week and start thinking about, further downside potential. Think about what deeper pullbacks could be. So, for me, and I hesitate to draw too many lines on a chart, because I think the problem when you do that, and techniques that I've seen that have a lot of lines on it, the problem is you will find something that lines up with something. And I don't want that to be my approach. I want my approach to be much more disciplined and focused on market behavior and investor behavior and market memory. So for me, seeing the fact that if I take the low in October and I take the high from last week or this, beginning of this week, we made a new swing high. You pull back from there, 38.2% is right below 36.50, which around 36.30. That actually lines up beautifully with these lows, with the low from mid-December. This is where we hit a couple times here. It's the upper end of this green shaded area that we've had. So for me, tells us we're right at that point. I mean, that would be sort of the last line of defense. I think as long as we remain above that, I think you could make an argument that this is a viable pullback before the next move higher. I think how a lot of individual stocks behave around this period will tell us a lot about what to expect there. If and when we break that, and I would, again, if you ask me to tell you where I think is the most likely scenario, I think we get down to around 3,200, 3,250 at some point over the next 4 to 6 weeks. I wouldn't be surprised. That would pull us back to the lows from September, October. I will tell you I'm wrong when we start reverting higher and we start making another higher low. But until then, tactical trend is lower. So right now, all eyes for me, the 50-day moving average, and if we bounce off of that or not next week on Monday, really. Further from that, does 36.30 hold? That would be the 38.2% retracement and the lows from December. And if not, it's trying to think about the further downside potential. And if the RSI remains above 40, in general, that tends to be more of a bull market characteristic. We spent a lot of time there on the daily S&P chart. Sorry, I was all excited to go through some of those details. Other things to pay attention to going quickly, and I hope you take some time to review the rest of these charts over the weekend. Cumulative advanced decline lines and whether they were able to hold the 50-day moving average. I wouldn't be surprised once these update a little later this evening if the NYSE and the S&P advanced decline lines break down through their 50-day, which would be really telling. We've seen a successive lower number of 52-week highs. We've seen less and less stocks holding their 50-day moving average. So from a breadth perspective, as we've talked about, the picture has gotten less and less rosy and less confirmational of a market uptrend. Finally, we have sentiment readings that look a lot like similar topping patterns. So the AAII numbers, the name exposure index, the RIDEX flow is all at euphoric levels now coming off a little bit, which to me, especially the name exposure index, speaks to people taking their foot off of the gas. It makes sense to have further downside as we digest recent gains, we reset, and then we determine whether or not there's a next leg higher or there's deeper downside to be had.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.